Good evening. We are the Madison Investment Fund from James Madison University, and we are presenting United Rentals with the ticker URI. They are the world's largest equipment rental company. So our investment thesis for URI is that they are really the market leader in a very much regional and fragmented industry. Their size within this market gives them economies of scale and market efficiencies that they can capitalize on and their smaller competitors cannot. We also see a fundamental pickup in non-residential construction spending going forwards, which, as we'll get into later, URI gets a significant amount of their revenue from non-residential construction spending. We also see a great buying opportunity being created in this company because of an irrational sell-off due to the current energy market, which we'll also touch on in a future slide.
So, as Jake mentioned, United Rentals is one of the largest equipment rental companies in the world, though their inaugural locations are located exclusively throughout the US and in Canada. They have a very basic business model in which they buy high-quality equipment from manufacturers and rent it to their very broad array of customers, spanning Fortune 500 companies down to the average Joe. They have over 3,300 classes of equipment to rent out. Before I get into the specifics of URI, I want to talk a little bit about the industry that they're in. The equipment rental industry, as Jake mentioned, is one that is very fragmented and very saturated. Most of these companies either have no employees or have less than 4. As you can see by a chart, around 61% have no employees. And we calculated HHI value for the equipment rental company, for the equipment rental industry of 282 out of 10,000, which indicates this is a very, very competitive market. But within this market, URI does have a very dominating market share of 12%, larger than the next two competitors combined. This gives them a very unique economies of scale and brand recognition that their competitors don't have. Within this market, they are very, very exposed to the non-residential industry, which is something that we see growing in the next 3 to 9 months and on into the future. Some positives for the industry that we've seen, there's been increased focus on government infrastructure spending, which is a topic that President Obama addressed in his latest State of the Union address. Something that a lot of people don't realize about these companies is that they're able to receive salvage value by selling the equipment at the end of its useful life and receive a little kickback on revenue there. The consensus estimates right now for the interest rate hike is in June, and we anticipate that people are going to be more prone to renting equipment versus buying equipment, just because it's much more cheaper than buying it. The low oil prices right now, I mean, there's more money within companies' accounts, and they're going to be spending that maybe to buy the warehouse that they didn't have the money to 6 months ago when oil was so high. And again, non-residential industry is increasing very rapidly, which URI has a 45% market exposure to. Getting into company specifics, they do have a very, very strong management team. Michael Neal has been in the equipment rental industry for over 30 years. He, along with William Plummer, helped to guide URI out of the financial crisis by taking over as executives in 2008, rolling out pay cuts, cost cutting where they saw fit, trying to bring the company up from the brink. Something that they've done is actually gone out and created something called Operation United, based on the Lean Kaizen initiatives, which basically means that they're training branch and district managers on how to run their individual stores better, how to run their individual districts better by cost cutting, streamlining business, increasing time utilization of their equipment, and raising margins on into the future. Another thing their management has come out and said is that they want to have higher margin equipment. This means more focus on pump equipment, more focus on air and specialty equipment, things that their competitors really aren't doing. They're going to be driving high margin growth into the future.
So United Rentals equipment rental revenue has 2 segments. One is general rentals, which currently accounts for 82% of their equipment rental revenue, and then their trench safety, power, HVAC, and pump solutions, also known as their specialty segment, accounts for almost 18% of the revenue. And as you can see with this graph on the left, specialty segment has very much more attractive margins than that of the general rentals, and United Rentals' economy of scale compared to their competitors allows them to penetrate into this market faster and at a larger scale. So how are they going to capitalize on this opportunity with the fragmented market? The 2 ways. One is with their very diverse customer base. So there is not one customer that accounts for more than 1% of United Rentals revenue, which we like because it shows that they're not too dependent on any one client for their business. And then their continued focus on key accounts. And what key accounts are is a customer that's expected to spend at least $500,000 on equipment rentals. And in 2014, revenue from key accounts increased 16% year over year. So they are implementing their efforts to increase their exposure to their key accounts. And they recently conducted a survey to 170 of their current key account clients, and only 1% of the respondents expected to see a possible slowdown in growth going into 2015. So what their exposure into their specialty segment and increased focus on key accounts allows for more cross-selling opportunities. So as they're expanding their fleet, they can offer more solutions to their clients that they may not have been able to offer before. The recent acquisitions of RSC Holdings in 2012 and National Pump this past year allows them to increase their exposure into the specialty segment, which allows for broader cross-selling opportunities. And they do have favorable market exposure, like we've been talking about. 45% of the revenue is derived from non-residential construction, and the value of a new non-residential construction project in 2015 is expected to be 7% larger than it is now. And going into 2018, the value of new non-residential construction projects are supposed to increase in value by 4% at a compounded annual growth rate. And we like that because it shows that there could be a higher demand with the increased value of projects. More companies are going to go get into new projects, which in turn should increase the demand for United Rentals equipment. Something to note is the American Rental Association expects that the industry is supposed to grow at 8% this year. That is the equipment rental industry. And in 2014, United Rentals saw equipment rental revenue grow at over 15%, which is almost double that of which the whole industry is supposed to grow at next year. So they are growing faster than the industry. And going to their lean initiative, their Operation United, trying to increase efficiencies. We've seen their equipment utilization has steadily grown over the past 5 years, which indicates that they are utilizing more of their equipment. Their initiatives to become more efficient with their fleet is working for them so far.
All right, so going to the financial statements, URI is looking pretty good. So as we see continuous operating margin expansion as well as revenue growth. So they've been able to grow revenue consistently while cutting expenses. So going here, we see a breakdown on this next slide of all three of their margins: gross margin, operating margin, and profit margin. So we see URI here in the blue, consistently beating the rest of their direct competitors in margin expansion. Something I do want to point out here that in 2012, with the acquisition of RSC, it pushed them more into the specialty market, which, as we mentioned, has higher margins, which we expect. And we expect with the acquisition of National Pump, their 2014 and 15 numbers to also be higher. And we think that this margin expansion is going to continue forward with their Operation United and the lean initiative, along with continued efficiencies. So going here, we see they do have high levels of debt, but that is the nature of the business. They take out lots of debt, build out their fleet, and then run out their equipment. S&P and Moody's has them as non-investment grade, but one of the initiatives that management is putting forward is to lower their debt to EBITDA ratio. So we think going forward, that's a positive. And here we see a positive trend in their tie ratio and EBITDA, with their interest expense remaining relatively flat. So as I mentioned, they've been able to grow earnings while keeping expenses relatively level.
So moving into our valuations for URI, we ran a number of different valuation methods, two of which being a DCF using Gordon Growth multiple, and also trading comps using an EBITDA multiple. For both, we used an 8.8% WACC, which is URI's current cost of capital. We also used a 2.5% perpetuity growth rate, which we pegged to what we expect long-term US GDP growth to be, which for an industrial company we think is a good estimate. For the terminal EBITDA multiple, we used 5.7 times EBITDA, which is URI's 10-year moving average. Currently, they're trading at a deep discount to this multiple, which is why there's such a large upside on this. Both of these methods give us roughly a 90% upside potential, which is phenomenal for this company. So as was mentioned before, URI gets revenue from two different sources, which are the US and Canada. We believe that the Canadian revenues are much less certain than the US revenues are because of the current economic climate in Canada and their currency troubles. So to test for this, we ran another simulation testing for Canadian revenues, which we adjusted down 25% and ran 1 million iterations of a Monte Carlo simulation with a triangular distribution on these revenues. Even with these very conservative estimates, we still were given an upside potential of 82 to 89% with a 95% confidence interval. As was mentioned in our investment thesis, we see a phenomenal buying opportunity being created by the current sell-off in the energy industry. URI only gets 6% of their revenue from energy companies. However, even with this, we've seen a very strong correlation over the past 10 years with IRYJ, which is the industrial index, shift into a correlation with WTI crude. We see no reason for this. We think this is because investors are running scared of oil, there's blood in the street, any names that remind investors oil are being sold out. This is completely irrational due to URI's very low dependence on energy companies for their revenue, and we believe this does nothing but create a buying opportunity. Thank you very much.